In module number 2, we talk about the interest rates on your student loans, how your loan servicers apply the payments that you make, and we also talk about interest capitalization. Now on your federal direct loans, and once again, for many of you, this will be your entire student loan portfolio, direct unsub and direct plus, also called grad plus loans. These loans have fixed interest rates, but please note that the rates change on new loans every July 1. What does that mean? That simply means if, for example, you come out of school and you have 4 direct unsubsidized loans, depending on the disbursement date, you could have 4 different interest rates, one on each of the loans you took out each year in medical school, and the rates will be fixed. Note that Direct Plus or Grad Plus always has a 1% higher rate than your Direct Unsub. You're going to see that on a table or a chart that we have coming up on another slide. So once again, the rates are fixed on direct loans, but they change on new loans each July 1. Campus-based loans, the rates are usually fixed. Just be sure you check the terms and conditions when you take out any campus-based loans. It's not unusual for campus-based loans to be at 5%. Private loans, the rates can be fixed or variable. You'll have to check the disclosure statement you get from your private lender when you take out a private loan. Now here's a listing of the different interest rates on direct unsub and direct plus for the past 5 years, including the current 2021 academic year. And you'll notice we have these highlighted in red. The rates this year, and by the way, these are called statutory rates. These are the rates that are assigned to the loans direct unsub and direct plus. This year we have the lowest rates that we've had in many years, direct unsub at 4.3 and grad plus at 5.3. Once again, notice each year grad plus is 1 full point higher than direct unsub. Now obviously during the period covered by the CARES Act, the interest rates on all of your direct loans, including direct loans from college, a post-bac program, and any loans you took out in medical school, direct loans, unsub, and grad plus, the interest rate is 0. No interest is accruing on these loans during the period of time covered by the CARES Act. But when the CARES Act provisions expire, this is what the rates will be on the loans you took out this year. Now, in terms of payment application, very important. Remember we said that for many of you, and probably most of you, all of your direct loans will be serviced by the same loan servicer. And regardless of which repayment plan you choose, you'll make one payment. It's called combined or single billing. The payment is applied proportionately a little bit against each loan that your loan servicer services for you. It's not an even split. So for example, if you have 4 direct unsub loans, depending on what the rates are, let's say your payment is $400 a month. It's not going to be $100 on each loan. It might be 80 on one, 110 on another, etc., etc. The payment is applied proportionately based on the amount of the loan and the interest rate. But look at number 2. If you make a voluntary payment on your loans, perhaps during a grace period, or you pay over and above the minimum required payment amount, you get to post that extra payment or the voluntary payment on the loan with the highest interest rate. That's a great way to get the best bang for your buck in repayment. Some of you may choose to pay off smaller balance loans with additional aggressive payments. But the important thing to remember is you don't really have control over that first payment. But if you make a voluntary payment or an additional payment, you get to post it on the loan that you want to. And there's never a penalty for early repayment. Please note the last item there. All payments are applied to outstanding interest first. Your principal balance will not come down until all of your outstanding interest is covered. Now let's talk about capitalization. Some folks refer to this as compounding. This is where the loan servicer on behalf of the lender, and in the case of your direct loans, the lender again is the federal government. This is where the loan servicer takes any accrued and unpaid interest and adds it back to the original amount that you borrowed, called the principal balance. That causes the principal balance to go up. This is clearly not a good thing, and the less frequent this happens, the better. Now, a reminder, during the period of the CARES Act, there is no interest accrual on any federal direct loans. Now, when can you expect for interest to be added back to the original principal balance? When is this going to happen? You can expect it to happen in at least 4 different cases. At the start of repayment, once again, for many of you, that is going to be 6 months after you graduate. Nothing really you can do about that unless you can happen to pay all the interest that's accrued up until the start of repayment. So it's going to happen at repayment. It will happen if you are late renewing an income plan. We have a separate module on the income plans like pay and repay. You have to renew those every year. If you're late, interest will capitalize. Interest will also capitalize if you switch income plans. We're going to talk about that later. But for example, if you started in repay and then moved to pay, you can expect interest to capitalize. You can also expect interest to capitalize if you have any gaps in your status. For example, we have a module on postponement. If you are postponing your loans with a forbearance all the way through residency, you have to renew the forbearance every 12 months. Well, if you are late renewing your forbearance, there will be a gap and interest will capitalize. So once again, capitalization, not a good thing. Try and control what you have some control over to reduce when this would happen. It's going to happen at repayment, but if you're using an income plan or you are using a forbearance, be sure you meet all the deadlines that you are given by your loan servicer for renewing an income plan and renewing any postponement options you are utilizing. This is the end of module number 2.